Hi, my name is Eric Balchunas. I'm senior ETF analyst for Bloomberg Intelligence, and today I thought I'd do a different kind of presentation, one that I use more in front of retail audiences, which is, retail investors like to see the ETFs themselves as opposed to going over trends and those kind of things. So today I want to go over 21 ETFs that our team is watching this year. It doesn't mean they're going to go up or down. It's just ETFs that we just keep thinking about and tap into some bigger themes for us. So without further ado, I got to get right into it because I got to get through 21 ETFs in 14 minutes. So let's just get started. First one, I think a lot of people know is ARK. This is the ARK Innovation ETF run by Cathie Wood. This thing is a juggernaut. And what it really showed was if you really swing for the fences, you can actually overcome the drought and the outflows that have hit active managers. And part of the reason for that is a lot of portfolios have gone cheap beta for the core, and then they decorate it with things that are totally opposite beta. We call them shiny objects. And so ARK has become a real something that you would put on to your cheap beta. And so we can tell in the flows that most of the money goes to cheap beta, but a good section of it goes to the sort of really high active share. And of course, the performance helps, and you have all that come together, and ARK has been a juggernaut. The question is, can they keep it up? A lot of the flows came in recently. And you can see, when flows come into a hot strategy, a lot of times it doesn't really work as well after. We'll see what happens. Right now, I think she's flat this year, but it's something to watch. She's going to keep expanding her universe of ETFs. You can see that there's 8 ETFs now, just launched the space one. So ARK is something we're always going to watch. It's a very interesting active strategy. Also, we're going to watch the Grayscale Bitcoin Trust. This is GBTC. It's not an ETF. It's an over-the-counter traded trust, and it's going to have a lot of premium and discount action. That said, it's really a sign of this race for Bitcoin ETFs. And until a Bitcoin ETF launches, the flows in this have been pretty good. I think it has 30 billion at this point, which is a lot. And here's the current state of the Bitcoin race. There's now 9 ETFs filed. We'll see if they get launched. We think September 30th is when we'll probably see the first Bitcoin ETF. If and when that happens, look for some people to leave GBTC or look for GBTC to convert to an ETF. Anyway, this is probably the biggest story going on right now in ETFs, and we'll see what happens. ESG, a lot of ESG is out there. We find the ESG that's going to work the best is the ESG that is the most benchmark aware. So you look at the holdings of this SNPE. It's a lot of like a lot of BlackRock ETFs as well. It's going to hold a Facebook and Exxon. That's going to turn off some hardcore people, but we think that the returns that are similar to the S&P will make a lot of advisors and institutions more comfortable. So we think that's probably where you're going to see the assets. We also like clean energy. Again, stuff that's very different than the index. So TAN and ICLN, those are ones we're also watching. I'll skip that. And let's look at the Vanguard Total International. So international has been left behind in the past 10 years. And an ETF like this, we're starting to see a lot more flows into as people rebalance into it. And you can see it's lagged the U.S. market by a ton here. So is emerging markets. And who knows, these flows and this rebalancing is going to start to add up at some point. And we have seen a little bit of a shift to value in some of the left behind areas. So we're watching VXUS for this international play. We're also watching the IPO ETF as well as 5.5, the SPAC ETF. And a lot of people think of SPAC, S-P-A-K, as the SPAC ETF, but SPCX is actually the better one, or I should say the more pure one, because it only holds pre-IPO SPACs. So these are the ones that are real micro caps before they announce what company they're going to acquire. The SPAC, S-P-A-K, holds mostly of the post-IPO SPACs. So this is the one we're watching, and now it's the biggest SPAC ETF. People are noticing because they want that purity. TQQ and SQQ, these are leverage Qs. This is the popular ETFs of the Robinhood crowd. So we're watching these to see what's going on with Robinhood, because you look at the volume in SQQ and TQQ, and that's a good gauge for how active the retail day trader is. And right now, you're looking here at the amount of volume going on here, and it's unbelievable. TQQQ in particular is the 4th most traded ETF on a daily basis. And it's triple leverage Qs. Now, if the Qs start falling down, you're probably going to see a rise in SQQQ as well. But when these two ETFs start dying down volume-wise, I think we're going to know that the retail day trader is starting to calm down a little bit. Maybe they're going to go out in the summer, pandemic's over, The market isn't as easy to make money in, and we'll look for that as a sign. But these are two we're watching. They're leverage ETFs punching way above their weight. MSOS, so cannabis is a big play. Biden's president. We're probably going to see more progress in the legalization of marijuana. And MSOS we watch because this is the only one that's all U.S. And the U.S. market is, I believe, 5 times bigger than any other country in the ballpark. So a lot of the action will be here. And this one is the only one that's all U.S. And it gets around a little. I won't go into the details, but it has a slick way of getting around holding multi-state operators, which is really an important part of the cannabis play. And it does that by using swaps on the stocks. And so it's grown quickly, and people have noticed this one as well. That said, the returns in this area are very volatile and uncertain. Sometimes even good news doesn't really push it. Sometimes it rallies randomly. It's a very volatile area, but one that we're watching, and this ticker in particular we're watching. And that's because you can see there MJ, which is the other cannabis ETF. You can see how much Canada it has in there, and that's normal for pot ETFs. Uranium mining ETF. So obviously we call this clean energy for realists. We think nuclear energy is going to have to be part of the solution for the world to get to net zero. And this is one that's been popping on that news. And it's the worst performing ETF over the past 10 years, at least the index. But over the past year, it's popped a lot. So it has a lot of room to run as well. And it's one that we're watching for that play. You can see how much it's up just in the past year. So a major pop there and something we're watching. iBuy, Amplify Online Retail. Obviously, online retail is major, especially with the pandemic. And a lot of this is going to hang around. I think people are like, people are just done going to stores. What we like about this one and what we're watching is that it's more equal weighted. And so you get way less Amazon because we think most investors probably have Amazon in their portfolio in a large amount somewhere else. So why double up that much? This gives you exposure to a lot of the other ones. So we sort of watch this one for a more proxy on online retail, not just Amazon. QQQJ, this is the next generation Qs. So these are the 100 stocks that are next on deck to go into QQQ. So it's sort of like the JV team. And we think the Qs are so hot, so popular, and the innovation in that index is amazing that it's just logical that this would be a launch. I'm surprised this hasn't been launched earlier. It took, the ETF industry is 23 years old. I'm just surprised it took so long, but this one has been an instant hit for obvious reasons, and it's one we're watching. We're also watching GOVT. This is the iShares Treasury Bond ETF. What's interesting about this one is it covers the whole curve equally. And so we find a lot of people will go into here when they want some safe haven asset, but they want a little more yield because if you go into the short term, you don't get a lot. So this one covers the whole curve, and we tend to see flows coming in this regularly. People like this. It's low cost, and this is one we're watching to see how people are feeling about the market as well. And you can see here it covers the whole curve in terms of duration. VTI. Now I think this is going to ultimately be the biggest ETF in the world someday. Right now it's third. The reason is this covers the whole entire market. It charges 3 basis points, plus what the sec lending Vanguard does, the revenue makes your tracking perfect. So you actually eat up those 3 basis points. So it's free. It's basically free exposure to everything. And what's interesting about this is it's FOMO proof, because when we saw Tesla get added to S&P 500 so late, a lot of people were like mad they didn't own Tesla earlier. Well, VTI has owned Tesla for 10 years. It owned GameStop. It owns all of them. So you never have the fear of missing out with VTI. And we think more people are going to come around to this and leave the large cap and the S&P 500. Not everybody, but there will be a migration, and we feel like VTI is one to watch for that. And you can see how S&P 500 was hurt by adding Tesla late. Also, the JPMorgan short income, same deal. People are not real keen to go into money market funds as much. What they are using is ultra short duration ETFs that are actively managed so that it's, relatively safe place to park cash. Although it can move, it's not a NAV of 1, but you get a lot more yield for that kind of a safety. And we're finding this area is very popular. Mint is another one from PIMCO and JPMorgan, and Vanguard just launched one here. So just trying to eke out a little more yield for is being as safe and as low duration as possible. And that's a hot area and a place we're watching. Now, QVAL. This is also part of our deep value. We think that the next ARC could be a deep value ETF, because if and when value starts popping like it is this year. Look for these ETFs here. This is our intensity rank for how value ETFs are. And you can see FEOL, DEEP, QVAL. These will pop the most. These will double and maybe even triple the performance of the Vanguard value or the Russell value. And so we think the way that ARK was a shiny object on the growth side, one of these could be a shiny object on the value side. And so we're watching these for that value comeback. Now, small cap value also. I think small cap value, of course, it makes us think that this is an area that might lead, right? So in the 2000s, small cap value destroyed the S&P. The S&P was flat. So things change, regimes change. And so we look for the small cap value area as a leading indicator for if there is a bigger regime shift. And this is one of the ones we watch. We think this one low cost. This is one people use. iShares also launched one called, I believe it's called SVAL. And it's basically a really concentrated small cap value. So it's also going for that shiny object potential. We do find a lot more launches these days are being they're very concentrated. There's a limited number of holdings. So be wary when you pick any kind of ETF, whether small cap value or total value, look at the concentration of holdings. Some are going to pop a lot and some are going to be more watered down. And so we on Bloomberg have created several tools that help you identify where on the spectrum they are in terms of their aggressiveness. And if you want any more help on that, just hit me offline on that. But that's something to watch out for. And let's go here. Just went over the flows for SYLV. Now, the IUSB, this is the total bond ETF. To me, this is a better version of AGG. The AG has been this easy to beat benchmark from bond managers. But when you compare them to the total bond market, which includes a little international and a little high yield, their beat rate goes down a lot. It goes more into the lines of like equity managers. And so this is a fascinating ETF. It's growing very slowly. It's very cheap, and it gives you the whole bond market, and it's a better benchmark for managers. So we're watching this one to see if the world can finally move on from the AG a little bit. So you can see the wider reach there and the steady inflows. Pacer, data and infrastructure real estate. Everybody thinks of VNQ with REITs, and REITs are for yield, and you wouldn't use this for yield. But this is an interesting play on data and infrastructure, especially if the infrastructure bill from Biden goes through. They're going to spend a lot of money on cell towers and that kind of thing, and that's what this ETF tracks. And you can see it's done a really good job in performance, but it won't yield for one infrastructure play that we might see happening, as well as an alternative kind of innovative in space. Now, GLD is basis points. Now you can get gold ETFs under 20, and GLDM is one we're always watching. We also watch gold in terms of how it's comparing to Bitcoin. Gold and Bitcoin have this rivalry now that we're going to see play out. And so GLDM to us is probably one that it will grow bigger than maybe all of them someday. And it's because it's cheap. And then DFAU, this is Dimensional. So Dimensional came into the ETF space last year. And what they did is they have active, but they price it at beta pricing. So it's a very, very low cost active ETF here. And this is working. We think if you're going to do active, you need to be really active, or you've got to be really cheap. And this one's really cheap and it's working. Also, DFA is going to convert a mutual fund into an ETF, and it's going to bring a small wave of products that move from mutual fund to ETF. In DFA's case, this is a $32 billion conversion. This, we think, is going to be the more popular asset-rich way for mutual funds to enter the ETF world. You bring your track record, you bring your assets, and you sort of start on third base instead of going into the sort of really brutal ETF market with nothing but this new launch, which is what some of them are doing through active non-transparent. So anyway, DFA taps into that issue as well. And then CN, this is a China everything. China is a pain. It's all kinds of share classes. CN is the easy button, and it holds it A shares, N shares, P chips, you name it. And we think this is an ETF that will grow if and when China starts, becoming more popular in portfolios. And then finally, the Simplify U.S. Equity Plus Downside Convexity ETF. That's a mouthful. People are nervous the S&P is going to go down real quick at some point. Like the sell-offs are quicker. So what this does is it holds the S&P, so you get beta. But then what it does is it holds some really out-of-the-money put and call options, so that if there's a real quick move to the upside, you can get a little extra juice on it. And if there is a real harsh move to the downside, you'll buffer some of it. So what they're doing is they're using options to sort of sculpt and protect on the downside. And this is a big area. We think that this kind of option overlay strategy is something we'll see more of. And so that's where we're watching this one. And I have just hit the end of my time. So 21 ETFs for 21. Thank you very much.